The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we're wrapping up the month of July and moving into August, let's examine this overall market picture. We have a lot of discussion to be had in regards to the U.S. and global economy. We have more geopolitical risk impacting the markets, it appears, here throughout the Middle East at midweek, and a lot of continued bearish sentiment in the grains overall. Livestock's a mixed bag right now. Let's talk about things. Joining us for a conversation, Mike Zuzolo with Global Commodity Analytics. Mike, always good to talk with you, my friend. Welcome back this week. Hope you're doing well.
Doing well. Thank you for having me back, Jesse.
Let's start. Maybe just give a broad overview of some of what we're watching news events wise Wednesday. I'm hearing a lot of chatter about various leaders of Hamas and other groups. I think even the Iranian Guard reports are killed on Wednesday. That seems to be having some impact in the crude oil market. So some of this geopolitical risk may be at play here in our broader market picture, Mike.
Yeah, interesting development, kind of set the table 24 hours ago before the Israelis ratcheted up and hit Iran directly, which historically would suggest that Arab nationalism will come in. And even if you're a Sunni Muslim like Saudi Arabia, in terms of country and their Muslim beliefs, which is a lot different than Iran and their Shia Muslim beliefs, they tend to circle the wagons historically. They did it in the late 60s. They did it late 60s, early 70s. They did it again in 2005, 2006. It could be a breaking point to a wider Middle East conflict. And 24 hours ago, crude oil was, I think, to me, the best example of what we had going in this whole commodity market. The idea that China's deflation and weakness was ramping up even more. And it took the grains back to a 2014 style market where all the rallies were just meant to be sold. And that's kind of where we ended today's trade, or we're ending today's trade before some fresh news from USDA. So there is a lot to unpack. I think the best way to start it off, though, Jesse, is the idea that two major streams of thought, I think, we're pushing this grain market lower. Either it was Chinese demand and the whole commodity sector was losing longs and bleeding longs, or the U.S. crop was getting so big ahead of a report, still 13 days away, the trade saw a cooler weather bias in the Western Corn Belt and said, let's get out of all of our longs that we have. Now that, to me, I'll just go on record, I choose the first one more than the second one, because I've got some charts here to look at that things don't add up to me that it's all about weather.
Well, let's talk about some of these charts here, and we'll weave in the China discussion as well with this. And I know you mentioned the USDA news. We're going to save that for the end of the show. So let's take a look at the Bloomberg Commodity Index, Grain Index here. We look at this quite frequently, you and I do. And, this whole sentiment in the grain trade, and to your point about these rallies have kind of just meant to be sold here. Walk me through what you're seeing on the Bloomberg Index right now, and let's start looking through some of these things that don't quite add up to you right now, Mike.
This has been such an excellent technical indicator for us, and I'm really proud of the analysis when it comes to trying to dial in whether we've got buy or sell signals utilizing this chart. I've got some other more refined charts that I don't share publicly and only share with clients and subscribers, Jesse, but this is a really good chart from a standpoint of where we're potentially heading. And when we took out the previous 2024 lows last month on a closing basis, it set us up for a major defensive posture. And we go into the end of July now, July 31st, with fresh 3+ year lows across the board, wheat, corn, and beans. And what two things that stand out with me on this chart right now, other than the very historically oversold conditions, is the idea that wheat is still very much a player here, because this chart wouldn't be where it's at if wheat wasn't joining the corn and beans with fresh 3+ year lows. So wheat is still very much a leader and very much a key, and that wraps itself into the Middle East conflict and the shift in the crude oil and the dollar that we saw Wednesday. The second point I'll make is this has been an excellent chart for me to suggest to clients possible next support levels and percentage moves in the corn, beans, and wheat, because they have been moving so closely with one another. This is the first box that ticks the idea this is more about demand, not more about supply. Yes, supply in the United States is good, and it's getting better by most, and if not all, indications at this stage. But it's the demand that keeps being looked at from a standpoint of it's still dropping. And that's why prices can't find lows. So the next big support, this is trading about 31.47 on the index as you and I talk, midday on Wednesday. The next big support is right around 30 to 30.4. So percentage wise, it could still drop another 4 or 5%, 3, 4, 5% if it wanted to. And so that's the really nice thing about this chart is it's been a good gauge of upside, downside potential in percentage term for the grains.
Let's look at another chart. And I know you got a bit of a correlation here between the Hang Seng and the Bloomberg grains. As we kind of weave China more into this discussion, Mike, what are some things you're watching here?
Yeah, the key with this chart is we just looked at the Bloomberg Grain Commodity Index and that new 3.5-year low in the index matching up with beans, corn, and wheat. Now let's see how much relationship sensitivity, whether it's positive or negative, it has with Hong Kong. And as you say, that Hang Seng Equity Index, knowing that we've had bad reports in a row this week with China. Today or last night, we got the PMIs, the official PMIs from China. The manufacturing number was a third straight decline in a row each month. And this month of July was well below 50, which is kind of the zero number. The non-manufacturing PMI for China was 50.2. That was down versus June. Retail, capital markets, property, all lower in July versus June. So that turned the Hong Kong market for the month down and made it go through key support levels on a monthly basis. Does that have anything to do with the grain commodity index we just looked at? This chart says yes, very much so. And it has ever since March, April, when the two were running almost 100% opposite one another on an 8-week basis. Then they ran almost 100% positive with one another. Now they've fallen back to about 60% positive with one another, but still a very strong positive relationship between that grain commodity index and the Hong Kong market. And until I see this go negative, I'm going to suggest to everybody out there, this is as much about demand in China, deflation, U.S. trade relationship with China, as it is about the U.S. supply getting bigger.
Let's take a look at Chinese crush margins a little bit. I'll pull up this chart. And what are some things you're seeing here? I'm always interested in hearing about some of the moves on the Dalian side, the Dalian exchange, et cetera. So what are you watching here, Mike?
Dalian meal has been falling pretty dramatically and is not far from where U.S. mercantile exchange meal futures is right now, Jesse. And whenever that happens, and when we don't have a meal-led rally, and instead we have to live off of the bean oil market for rallies, and that's been the treacherous thing about the month of July for the soybeans, is the canola jumping 4 or 5% one day, 5-6% down the next day, or so on and so forth. But this is where the rubber hits the road. China's soy crush margin is now the second lowest since 2024, and it's a negative $64 a ton right now in US dollars, and it's just getting worse as the year goes on. This just suggests more strongly that as long as Brazil keeps a cheaper price against the United States at Paranagua, then we're going to have a tougher and tougher time to get in there and get some business from China. And I think that's the heart and soul of what happened in July. May was about wheat going down. June was about corn going down. July, they've taken the premium out of the beans because I think they recognize in the trade, not only do we not have a problem with the crop in Brazil, but we also have a real demand issue for the United States.
All right, I said I was going to save this for the end of the show, but I guess I meant to say end of our grains segment here. This other piece of the puzzle, Mike, you alluded to this earlier. An acreage review from USDA coming up here. Talk about this news that came out on Wednesday that looks like it's maybe having a little impact in the market.
Yeah, I think it's turned some traders into more of a spread mindset and short covering led by the wheat and the soybeans, and it makes sense. What this press release says, and I actually reached out to the head of NASS after the June acreage report because I saw that corn acres left to be planted were about 2.5 million. That was a little over a million more than last year in June. Beans was even greater. It was about, excuse me, it was 3.3 million in the corn versus 2.5. The soybeans were 12.76 left to be planted in June of this year versus 8.2. So we're talking about 4.5 million acres more left to be planted in soybeans this year in June versus last year. And so I sent an email to the NASS director and said, are you guys going to look at this at all before the next crop report? And they didn't send me anything back. Now they're going to update the acreage base. And so I think the trade's caught wind of the idea. We're probably going to see a reduction in spring wheat, durum wheat because of the flooding. Probably going to see a reduction in the soybeans because of the same thing up in the upper Midwest. Minnesota, Iowa, Dakotas are key areas to be watching on the August 12th crop report to see if those planted or harvested acres drop enough to offset potentially this yield increase that I think the trade's trying to build in.
Yeah, could make for a interesting August WASDE report, no doubt, and something we'll have to watch very closely. We're talking today with Mike Zuzolo from Global Commodity Analytics here on Market Talk. Mike, let's go over to the livestock sectors. We wrap up the month of July, and I have to think here as I pull up a feeder corn ratio chart, one area that has been an interesting one to watch, grain producers obviously not happy with the price levels, but our cattle folks have to be maybe happy with some of the cheap feed that's out there. Talk about this a little bit for us, Mike.
Yeah, I mean, this is going to be the most important chart for the cattle rancher in August, in my opinion, Jesse, because we saw Oklahoma City get a little bit soft this week in its cash auction sales. Sale barns are still red hot out in the primary cattle country, but we are seeing, I think, a little bit of a softening mindset, and we've got the yearling sales now mostly through at this point. And so this feeder corn ratio has broken to a new 2024 high, actually has gone up to the new best high on a monthly closing basis since this is the end of the month. Feeder's now 67 times the price of corn at this point. The high on a monthly close was back in 2014 of 74 times. So we're trying to snake our way up towards that high. And I think this is the big push to the upside potentially for the feeders. And if that corn would turn around in the month of August, I'd say to the cattlemen out there, be ready for, number one, the feeder price to start to go down or at least peak. And number two, if you haven't gotten your corn purchased, you've been sitting on your hands and doing better by sitting on your hands than I did 30 cents ago. And roughly speaking on the futures, probably like 15 cents ago when it comes to the cash corn per bushel. It's time to get your hedges locked in on your feed side because this is the big driver, one of the big drivers that's been pushing this corn price lower and lower.
Let's look at cattle futures versus negotiated cash as well. Our last chart here for us to take a look at today. And I think to some of your points here, some interesting correlations to watch here between cash and futures right now, Mike.
Yeah, and this is the big deal with the cash market, and this is why the futures has been all over the place this week in fat cattle, in my opinion, Jesse, even though the hogs have still stood up with a very strong pork cutout. But look at that white line. That's your negotiated cash cattle price USDA gives us in the afternoons and then again in the mornings. And we have bounced around this week from 187 to 195, and we went back down to 198 Tuesday night, Wednesday morning. And this is not a good signature on this cash negotiated price. Look at the highs and lows, the sawtooth or the saw blade looking type price action versus what we were looking at last year and earlier this year, where it was steady declines, corrections, steady declines. Looks a lot wilder, and that usually indicates to me that we're running out of runway for new longs to come into the market in the cash market. And so I think this is a wake-up call to the trade. It's certainly a wake-up call for me to get those feeders knocked down on the hedges and get those fat cattle knocked down as well. the last thing I'll say about the fat cattle market is we saw the McDonald's earnings on Monday. The global sales went negative this past quarter for the first time since the pandemic, or 3 years ago. I think that too really shook some of the pillars of the bulls in Chicago at the Merc. So please beware of this if you're a rancher looking at Q4 marketings and getting ready to lock some good profits in.
Great stuff. The hog trade as well. That's one area we've seen futures rally, of course, as of late. Maybe running out of steam. Demand, though, has still remained fairly good. Any notes in the hog trade, Mike?
Yeah, I agree with you. The seasonal's getting old, and the hogs are going to get more sensitive to China. And I've been impressed with them not dealing with the negative side of the Chinese market, because usually that pork and bean trade works very well, but the seasonal has overpowered that. Wouldn't be surprised to see the hogs and beans team up again in the month of August, though. And I think that's the heart and soul of this market. It still is. If we're going to take corn lower, then we've already gone on this idea of whether it's weather or China demand. I really think soybeans are probably the leader to the downside that would push corn further, even lower than this 380 area, Jesse.
A lot of great analysis weaving together this whole geopolitical, foreign economy, China, U.S. economy picture, you name it. Any final thoughts for folks listening in here today as we wrap up the month of July and move into August, Mike?
I'd say get a trial here, get a free trial at this point, because I'll talk a lot about 2014 and what happened in 2014. Every year's different. But if the heat comes back in August, I don't think the trade's ready for that. If China comes back with new policy, I don't think the trade's ready for that. And Jesse, I'll tell you, I think they've taken way too much risk premium out of the crude oil market if we turn into a regional war at this stage of the game. And I don't think there's enough premium in that crude oil market either. So a lot of reasons why the grains can bounce and the commodities could be bought and rotated into. I think it's a great time to pick up a trial at globalcomresearch.com.
GlobalCom with 2 M's, research.com, globalcomresearch.com for more information. Mike Zuzolo, Global Commodity Analytics. Always great to talk with you, sir. Thanks for joining us today. We will talk to you again next week.
Thanks for having me, Jesse. Take care.
That's going to do it for Market Talk today. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.